Well, we have the rare treat of having Morris Sachs back for another VWAP segment. Videos we analyze and pull apart. You know, the first one was such a big hit, Morris. We had to have you back.
Delighted to be here, and it'll give me something to do till the weather improves.
Now, today I have a little bit of a different theme for us, and it is one that is near and dear to your heart. So we're going to start with this interview that I heard, and it was with Torsten Slok from he's
a good economist.
Yeah,
he went to Apollo, right?
That's right. He went to Apollo, and what I was amazed was he has a great little podcast, and he had the Apollo private equity guy on, and I'm thinking to myself, oh geez, you know what? They're just going to sit there and talk about how great private equity is and how everything's so awesome, and it was the most refreshing take I've ever heard. And so let's play it.
Great.
So let's start with a simple question, namely, Matt, can you give us an overview of where is private equity today and how did we get here?
Sure. I'm not sure this is the perfect analogy, but it's probably a lot like waking up with a hangover. You're a little disoriented and you probably regret some of the decisions you made. Thinking about where the industry has been.
Do you think that's true?
Where do we begin?
But do you think it's like waking up with a hangover?
So Apollo, I just want to make sure I got this right, because as you get older, you'll discover this. You get a little confused. Now, Apollo is the one where Leon Black was the chairman.
That's correct.
And then he had extracted a very large consulting fee for advising Jeffrey Epstein on estate planning.
Please,
do I have that right?
Please just be kind. We don't want to get in trouble.
No. Hey, look.
Yes, you are correct.
None of this is investment advice.
I'm sure there's lots of lovely people at Apollo.
Of course. In fact,
Torsten and this guy that's telling it as it is, which was just blew me away. I did not expect it to start with, it's a little bit like waking up with a hangover. They haven't even had any down ticks yet, and this guy's already talking about waking up with a hangover. Okay, let's hear why.
Just really for a while, just a tremendous amount of excess. There was a 40-year bull market in rates. The Fed printed $8 trillion in capital and liquidity. And so we experienced that everything bubble, not only in the public markets, but in the private markets as well. And so if you look at where the industry has bought assets over the last 10 or 15 years, really post the financial crisis,
I wouldn't mind if you just stop it right there. There's that thing about the three greatest lies. One of them is the checks in the mail, and the other two you can look up on the internet.
Okay. I didn't realize there's three. I thought there was two, but I'm going to have to go look up the third.
I got just a generic bug up my ass about these enterprises that collect fees from investors. Okay. And private equity rebranded itself because it used to be LBOs, leverage buyouts. And if you don't know how private equity works, my experience, which is not all that broad, but it's been dismal, is you commit to an amount of money. So let's say, for instance, you said, put me in for $1 million, but they don't have any companies yet. So they get a bunch of guys together, and let's say they raise $50 million. And the second the deal closes, the clock starts ticking. So they're getting 2% on their $50 million. And all they've done is got themselves a nice office building and some secretaries and probably some snacks for the analysts and stuff like that. And then they go out hunting for companies that they can buy on the bid side, strip the assets, and liquidate stuff, and hopefully there's something at the end. Now, you are very familiar with that iconic movie, Wall Street. And to me, they explain leverage finance perfectly, where Charlie Sheen walks in the meeting and they're talking about taking the airline and selling the gates, and they're going to take the underfunded pension plan, and they're going to buy an annuity, and they're going to walk away with $100 million. Yeah, there's no value creation. This is just financial alchemy at the expense of the shareholders of the company who aren't getting full value for their company, and the relationships that the private equity guys have with the lenders to secure financing. And the reason that
but it's amazing this guy even said this stuff, because I think you'd find that this. Let's just play a little bit more.
Okay, sure.
I think you're gonna be surprised at the stuff he says. He's gonna be more in your camp than you might expect.
Higher.
Here we go.
So if historically the average multiple for a business in private equity was about 9 times cash flow, people were paying 12, 15, 20 times cash flow. And a lot of that was supported by cheap debt. So leverage levels increased across the industry as well. This is all changing now. Money has a cost, as you well know. And so what we're experiencing right now across the industry is navigating this pivot. So what is the economic outlook going to look like? What's financing going to look like? And that uncertainty is really having a significant impact on deal volumes this year.
Yeah, and the environment we've had with very low rates for a very long time is obviously very critical.
Stay
also for
with
thinking
us,
about
Morris.
the macro outlook. So looking ahead, what does it mean when the cost of capital now is permanently higher and inflation, as you and I talk about frequently, is much more stubborn and sticky? And
it's interesting how much has changed and how quickly it's changed. So even if you compare where we are today to a year or so ago, on any consideration, any metric, whether it was inflation being low and stable, now high, as you mentioned. Valuations have come down. The cost of financing is significantly higher.
Hey, Kevin, what's the date of this interview?
It was a month ago, I think.
Yeah, and you know how you know the jig's up? Look at all the guys getting fired on Wall Street.
Oh, 100%.
Full stop. And so I worked on Wall Street, and a couple of times I was in the expense review committee.
Yeah.
At the firms I worked at. There's only one way you reduce expenses on Wall Street. You start firing people. Yeah. And so the firms themselves are acknowledging that there's not going to be many deals. And not to get too complicated, but as you know, I'm a bond guy, not a stock guy.
Yeah.
And when you look at an inverted yield curve where, let's say the funds rate's 5% for a round number, and the long bond, I don't know where it is today, but call it close to 4 maybe. That long bond yield is supposed to be somewhat similar to what a long-term investment in property, plant, and equipment might be. So how is private equity going to go out and borrow money at 5 and buy a business that's generating income at a return of capital of 4 or something like that?
Well, and that's what this guy's point is, that it was, it was a 40-year bull market or declining rate environment, and private equity just continually levered up more and more. And he is bullish. He's bullish on the stuff that they're going to buy in the coming problem area. But the people that are going to, well, listen here, I got one. You obviously are having trouble listening to too much Apollo. So I got one for you. You might like better.
Know,
here we go.
We'll know when people are suicidal.
I don't think the real estate guys are quite there yet.
No. Well, you and I were talking before.
This is Howard Marks, and he did a great interview, and he's talking about he's talking about private marks on. I think this is real estate, but I think it applies to everything. Let's just keep going.
Started about denial, and
I didn't say that.
And well, look, and what happens in illiquid assets? What happens in the liquid markets, the listed markets, is that prices collapse. What happens in the private markets is that there are no transactions.
They stop trading.
Because the buyer wants a price which is commensurate with current conditions, and the seller hasn't accepted that yet. Right. So obviously there's no meeting of the mind, there's no transactions. And usually after a while, somebody has to sell for any of a variety of reasons, and that's when the prices of private assets decline. Yeah. There's been a big discussion.
Here, do you want to comment on that?
Well, I think, this is where the guys like Howard Marks and Seth Klarman are two names I can think of. There's another fund, I think Canyon.
Right. Canyon
these are distressed guys, and we're entering their domain because they have access to capital and they have access to people with analytical skills. And so, I see this happening. There's a big REIT, and I think it's owned by Blackstone or BlackRock? Blackstone.
I think it's Blackstone.
Okay.
The B REIT you're talking about, the world's biggest REIT or whatever it is. Yeah.
Yeah. So that's going to be an interesting litmus test as to how this thing plays out, because Blackstone has access to financing that most people don't, yet the price of the underlying assets are the price of the underlying assets. And if you have a good building in a bad market and your tenants are paying, you'll be able to carry your debt load. If you have a building that's not, and you don't have a special arrangement with a lender, then the liquidation is going to take place. And this is where guys like Howard and Seth, notice I'm on a first name basis with them, obviously.
You saw them building their wall too, trying to fix their wall.
I think that's exactly it. But what we were talking about private equity, and this is the part about private equity that I don't like particularly, which is if it doesn't work, they generally just effectively throw the keys back to the bank, meaning, right, the company goes bankrupt. What I learned through some experience in real estate development is if you're going to take out a construction loan, which is the riskiest type of loan you can get in real estate, somebody's on the hook, meaning you just can't say, we fucked up, here's the keys, bank. There's some deep pocket guy that's going to have to come up and finish the project. You don't have that in these other things. And that's why I don't like, or I won't give money to private equity, or I stop giving money to hedge funds, stuff like that.
I think because all of this private stuff is a problem. And here we're going to talk about the marks that they're doing, because you mentioned how we're entering this period where public markets are down, yet the private, there isn't any trading.
Well, there's no marks. There's no marks. It's idiosyncratic. No marks, so they just
kind of say, okay, you've gone up by your cash flow, and that's it. Like what was amazing last year was we had a situation where almost every financial asset in the world was down anywhere from 20 to 40%, depending on,
right,
the duration and stuff. And yet we had private debt, private equity, and even private real estate marking up on the year.
Yeah, and, I don't know how they did that. I would imagine the argument went something like this, which I don't agree with, but they probably said, I was going to say that they were going to argue the cap rates went down, but the truth is rates went up, cap rates went up.
Right.
So I just don't see how.
Here, you know what? Instead of giving us a reason, why don't we listen to what Howard does, and you can respond to him.
Great.
Last year was one of the worst years on record for the stock market, and first or second worst year on record for the bond market, and maybe the worst year on record for the 60-40 mix of stocks and bonds. And yet, most private investors didn't mark down their portfolios much, if anything. So there's been a discussion of the propriety of that relationship, and every private asset owner has an explanation for why they haven't marked them down.
Well, the explanation is simple. They don't have. No, and I mean this seriously. they don't have a regulator making them justify their marks to maintain capital ratios.
100% agree. Okay, here
you agree with that, right?
Yeah, completely agree. Let's keep on with Howard.
And I want to interject here that they're not all nuts, because the argument is that private assets have not shown enough volatility, but I would submit that public assets exhibit too much volatility. And when you mark your private portfolio, the decision rule can't be set a price which is commensurate with the doomsday thinking that's prevailing in the public markets. That's not the right idea either.
Well, so he's in between. He's given them a little more credit than.
I guess having multiple experiences of having to put prices on stuff, because remember, in my line of work, you got paid based on your P&L, and your P&L got closed once a year, right?
Right.
And so while we had nothing but listed regulated securities, we could have a bond that didn't trade in 6 weeks.
Right.
So how do you justify
where you
that
should
price?
Yeah, you got to dream something up.
And you just can't stick your finger in your mouth wet and see which way the wind blows. You got to have a reason. Now, I agree with his logic that you don't need to take the desperation mark and mark everything down, but there are plenty of reasonable arguments that you can make to reprice illiquid securities and come up with a commensurate mark. But private equity isn't, at least my way of understanding, they're not being forced to mark to market, other than by their lenders, I would guess, right?
Yeah. And, back to your point about in your day, you had to mark stuff. And I can't remember if it was Ace Greenberg or it was somebody at Salomon Brothers that, when a trader submitted their ending bid, they would sometimes make the trader go sell some at that price.
Sure.
And if they couldn't sell any, they were fired on the spot.
On top of that, or in addition to that, we had aged inventory rules. So if you owned a bond after 90 days, they marked it lower. Even if, there was no reason to say the bond was cheaper, it would be called aged inventory, with the logic that, if you are sitting on a bond after 90 days, there's a reason you're sitting on a bond after 90 days.
Okay. So one of my worries that I have is that, and I think Cliff Asness has talked about this from AQR, and there's been other people that have mentioned this, is that originally private equity, private debt, these assets traded cheap, meaning you could get better yields and buy companies on cheaper because of the liquidity, illiquidity premium, meaning that, if you couldn't buy and sell it on a regular basis, people wouldn't pay as much for it.
That's right.
One of my worries, and I think Cliff Asness is talking about this, how people are doing volatility. What does he call it? Like rinsing.
Volatility weighting.
Yeah. Or what?
Position sizes.
Not weighting it. They're buying these private, equity or private debt because there is no volatility in them. Meaning that you can say my portfolio is more stable than a publicly traded portfolio, and just look, here are the marks. But we all know the marks aren't real. And so one of the things is, when I was watching Bloomberg the other day, I was watching this woman, and she actually said it out loud. And let's just play it.
Stephanie, you then like private investments as a way to get some exposure in this difficult environment. Why, though? Is there not some degree where private investments are also going to be closely linked with this cycle?
There is a link. But what I would say is, if you take private debt, for example, typically you're lending directly to the company. And so you can step in and try to find a solution a lot easier, where if you're just buying a bond, it's tougher to really enact change in that manner. So you can get a lot higher yields than you're getting in the public markets. they do not mark their value quite as often. So for our clients, whether there is volatility on a day-to-day basis in the public markets, because you don't see those marks.
You can stop it. That's just someone who has no understanding of reality.
Right.
That's not how it works. As a friend of mine, I'll call him Big E, once told me, you never get better terms when you loan money than the moment before you give the guy the money. The notion that, and it's true, the notion that you can control or have better terms because you're making a private loan to somebody, that's just obtuse.
Right. But she then goes on to say that the fact is we don't see the volatility, so therefore we're more comfortable with it. Which is just nuts, but that's in essence what's happening out there, Morris.
Well, I don't know what to say. I mean, Liam and I weekly do this podcast, and listen, it's never going to go mainstream.
What's it called again?
Inside Baseball with Old Chestnut.
Okay.
It's never going to go mainstream because it's harsh, it's vulgar, it's just two guys having at it. But having been doing this since I've been 19 and I'm about to be 63, I've seen all this bullshit. And, the notion that you're buying something illiquid so that your P&L doesn't have volatility is insane as Kathy Wood selling NVIDIA because she decided that there was a boom in the chip market. Well, excuse me, but how is your fucking Robo Taxi going to come pick you up without some supercalifragilistic chip in it?
Right. By the way, the 2019 original Kathy Wood model said that there would be 5 million Robo Taxis, Tesla Robo Taxis picking us all up in guess what year?
Don't confuse me with the facts.
2023. So I'm waiting for it. We got 6 months, but I'm very confident.
So what's her call on Bitcoin? 1 million?
Oh, I don't know. Don't even start.
Well, let's just say 1 million. My plan is when it gets to 650,000, that's when I'm getting in. That's my plan. We'll have a breakout on Patrick's charts.
Okay.
And that's the point to get long.
So I got one for you, a little old one. This is back from 2018, but it's a guy we both respect in terms of a trader getting interviewed by a guy that you like to talk about. I wonder if you recognize the voice. Here we go.
Let me just take you to 1987. That was a big moment for you. The year of the great crash.
Well, the crash of 87.
Do you know who that was, by the way?
I didn't hear the first voice,
we'll
but the second...
We'll have to redo it. 1 second.
Let me just take you to 1987. That was a big moment for you. The year of the great crash.
Well, the crash of 87.
I'm surprised you don't know. He managed your favorite firm. He's a commodity trader turned CEO.
What? The guy from Fibro?
No. Well, was he from Fibro originally? You mean Lloyd Blankfein?
No, I didn't recognize the voice because I remember him sounding like a whiny little bitch.
Morris, come on, buddy.
Sorry. Hey, you can edit it out.
No editing on the huddle. Here we go. Let's play Paul Tudor Jones' response.
Was really interesting, just because the crash of 87 probably never would have happened except for, again, the market infrastructure at that point in time. I remember, because I started out in 76 trading commodities, and so for 120 years, all commodity futures had limits. And I remember so many times in the late 70s, early 80s, where the cotton market would be limit up, or the soybean market would be limit up, because that was the allowable amount that prices could move. And they would not let them go anymore because they knew the irrationality of human nature and the possibility of what a mob can do to anything.
That by the way, is technically incorrect. I'm sure you realize that, Kevin.
What's that?
So he's saying that they put limits, which is not exactly right.
Because
first of
the front
all,
month didn't have a limit, right?
That's number one. Front month, spot month never had a limit. That's number one. Number two, guys would use in the money options to create tradable securities. So the notion that you had these circuit breakers where the cotton could go down 2 points and it couldn't trade anymore. Well, maybe the back months couldn't. The front month could go wherever it wanted, but then you could use in the money puts.
They didn't halt those?
Yeah. I'm sorry?
They didn't halt those? Like they didn't stop them from trading? Like there was no limit there?
I didn't trade cotton, but I remember with the bonds, you could trade
No, so the bonds, he definitely talks about it being different. Let's just listen to Paul here.
Okay.
Here we go.
So futures come along. Here's a funny story. Do you know I tried to work for Goldman in 1984? When y'all were first thinking about futures, and they went, that's not futures. No, we're not.
Listen, I couldn't get a job.
We're not going to do that because we're Goldman. We're not going to be in that.
I didn't get a job at Goldman. I only got a job at J. Aron.
Okay.
And J. Aron was bought by Goldman.
That's right.
Yeah.
Right, that's right.
So what is it with these Goldman guys?
I thought you'd like that, buddy.
Yeah, they didn't hire me either. So I guess Lloyd, Paul, and I have something in common.
You guys should get together and just bitch about it.
Unbelievable. Yeah. I think the world of Paul Jones. I don't.
Sorry, go ahead. You think the world?
No, I was just going to say I think Paul's the real deal.
Oh, I agree.
I think he's a real gentleman, and people. And I've known a number of people who have worked with him and for him, and he's a AAA guy. The other fellow is, the deepest part of the deepest sea at high tide. Just absolutely talentless, mean.
Stop it. Here we go. Let's play the thing.
There were no limits. There were no limits on any financial futures. It was just an absolute accident waiting to happen. And then they started portfolio insurance. And in '87, you could just look on any kind of historical metric and see the stock market was stupidly overvalued. 10-year rates were 10.5%. I think the dividend yield on the stock market was about 4.5 or 5. So just think about that compared to today, right? 500 basis point, we'd have 10-year rates right now at something like 7.25, 7.5.
The forward prices of stock would have been a hell of a lot.
Yeah, exactly. But they weren't then. And so when the market finally broke, I mean, the one thing that I would say I've learned the past 40 years is these, price patterns and price stories. It's the same old story so often, just with different characters, different times, different plots. And
so I tend to agree with that as you get older, you just find more and more the stories. You're like, come on, we've done this. Does nobody remember?
It's funny. I don't know if you've got time for
you go ahead, tell your stories.
A cute Paul Jones story. So we mentioned it in the past how he made a lot of money being long 5-year futures on the cotton exchange. I was the other side of the trade, but I had it hedged, so it worked out okay for me. And a couple weeks after the event, I got a call that this guy Paul Jones wanted to see me, and so I made the trip into New York City. His office was one of these Class C office building kind of things, like the elevator barely worked, and it was right near the World Trade Center. And I sit down, and real nice guy, round glasses, shirt with a tie on, very professional, and with that Southern draw is like, Morris, I hear you were the other side of my trade, and I hear you did very well. I'd like you to tell me how you made the money. And I said, I could understand why you'd like to know, but I don't. There's nothing in it for me if I tell you how I made this money. And this is the part I like. He says, Morris, I could teach you to paint, but it ain't going to make you Picasso. And I said, that may well be, Paul, but you're out of luck there. And
that's a great line.
It is. And, you know, there's many people I keep in contact with. I didn't never really developed a relationship with him, which is too bad because I think we would have gotten along very well.
Sure.
But I think he's a decent guy.
I think he's a great guy, but I think his trading, I don't know if you could have ever worked together because I think he's a little bit, he trades a lot and he changes views a lot. So you got to, and kind of like he's old school that way. But the one thing I love about him is actually his that idea that if it's above the 200-day moving average, I buy it. If it's below it, I sell it. And if I feel the other way, I don't trade. And
gotcha.
And it's so simple, and it seems so like almost dumb, but it's so true. It just keeps you out of so much trouble.
Well, there's this story about golf, which fortunately through therapy I was able to cure myself of playing. But Ben Hogan, one of the greatest golfers of all time, would, you know, come to a course he hadn't seen, and he asked like two questions. One was, you know, which way is the prevailing wind and where's the water? And then he'd go out and break the course record. So there's people out there, and I'm sure Paul is very bright, but there's people that just have a knack, and it shows up to them in certain ways, and it may manifest itself to him in the 200-day moving average. I have my own way of doing things where I sort of get a kind of a picture in my mind, and I don't know really where it comes from or how it gets there, but more often than not, it turns out to be right. And that's kind of more of the, you know, art than science of trading, which I think all good traders would probably tell you there's an element of how they make money that they can't really explain.
Oh, not only that, if you think about, if you gave a subject to two great painters, like you mentioned Picasso, and then you pick someone else, it's going to be completely different. So how they go about making money is going to be different, just like that. Okay, so we're going to end with something fun. And I was trying to figure something.
This hasn't been fun?
No. It's been fun. But I thought there's something that's off. Okay, so something fun that's non-market related. And so for those who don't know, Liam and Morris's podcast features 2 to 5 minutes of excruciatingly poor quality fish at the beginning of every episode. And they are a bit of a fish fan. So I was thinking I got to do something in honor of their fish fans. I got to do something. And I figured something out. I figured out there's something called Reverse the Verse. And I'm hoping
Reverse the Verse.
I'm hoping you've never heard of this, because they ask musicians if they can name their songs after they are played in reverse. Now, I personally think that all fish songs would be tough to hear, even if they played them normal. So I'm probably, not as much at a problem as you are with this. But I just want you to know it's with Mike and Trey, and they only got 3 of the 5. And in fact, Trey only got 2 of the 5. So we're going to make it, if you can get 2 of the 5, you're going to have tied Trey. And if you make 3, you'll actually beat them as a pair. Okay, you ready for it?
Let's go.
Hi, it's Mike.
Hi, this is Trey from Fish.
And this is Reverse the Verse.
Reverse the Verse.
Here we go.
Reverse the Verse. We're going to listen to our songs in reverse, and we need to guess which song it is.
We should know whatever it is backwards.
It's much better than any of our forward songs.
Okay, now I gotta say, I already love these guys. The fact that they're joking about this and saying
no clue.
You got no clue? Because I don't think they do either.
Minor songs?
Yeah, here they go.
20 years later.
Oh my God. Harry Hood.
That's all major.
Have you ever heard of this?
Harry Hood?
Yeah.
It's a classic.
Okay.
Yeah.
Okay. So you're 0 for 1 so far. Somehow I'm worried that you're going to be 0 for 5. So I'm going to say, I'm setting
stop at 3, because if I can't get Harry Hood backwards,
no, but to be fair, Trey didn't get it either. And I will tell you this, they got the last 2. So it could be that maybe they started too hard. Okay, here we go. Second one. Here we go. Wait, I screwed up. I actually hit the... Oh, no, I did it right. I'm sorry. Let's try this again. Here we go.
These songs are all so much better backwards.
Can we just release? We should do a best of backwards.
We've only got a few years left here. I think everything should be back.
So do you have any idea?
Nothing.
God, so you're going to this is not looking good. You need
What
Liam.
is that?
Everything's Right. You ever heard of that song?
Oh, Hang On Tight. Yeah. That's a song.
That's a song. Okay.
Yeah.
I'm very worried this is not going as well as I hoped.
Well,
Okay.
I don't have to face the studio audience and try and win a car.
Okay, here we go. Number 3.
I have no idea what it is, but that is good.
You
backwards.
got me.
Oh, I screwed up. I said it. Did you actually get it?
No. You got me.
Okay,
0 for 3.
So now, God, this has gone horribly. But hopefully the last two, which Trey got, you will also get them. So there's a lot of pressure here. Here we go.
I just don't do enough drugs, Kevin. I'm
I guess
sorry.
so. You're falling down. Down with the disease. Okay. Now your last chance. Your last chance to solve.
0 for 4.
You needed Liam. I'm pretty sure you're going to get this one because Trey seemed to get it right away.
Okay.
You get it? Oh my God.
You enjoy myself?
You got it. Well done. Way to come up big and save my segment I created.
Old Chestnut pulls it out of his ass at the last minute.
Is it the only big song that we didn't do? Is that why?
Yeah, they only have 5 songs.
Well, you know what? They only play 5 songs a concert. Let's face it. Even though the concerts are 3.5 hours long.
You haven't been to a fish show with me and my gang.
Well, I guess we're going to have to do this.
Anyways, we're gonna have to
Morris,
do
why
that.
didn't you tell people where they can find out more about your market views and the occasional fish anecdote?
And thank you for pushing me to do this, because the marketing department, they try and get me to go to shopping centers and art fairs, and schools to bump up our listeners. But Inside Baseball with Old Chestnut, it's IBWOC.com. It's me and my good friend Liam Allen, and we try and impart some humor, some current market views, and some stories about things in our career. And we've not gotten a huge audience, but a solid group of listeners who are very eager to comment and ask questions. And it's been a lot of fun. And I'd be delighted if people would give us a try.
Well, Morris, thank you. Thank you very much, Morris. It's always a pleasure having you on and hearing your views. And hopefully you don't get us into too much trouble with all those big wigs that you insulted. But that's what makes Morris, and it's just tons of fun. And thank you very much for your time. We really appreciate it.
Thank you. Good luck. Be well.